information. Mercer are the appointed investment advisor of the DEWS plan and deemed to be the largest investment consultant globally, advising on around $16.2 trillion of global assets. And then from Zurich Workplace Solutions, we have Daniel Lewis. Daniel will be facilitating the Q&A section for us at the end of today's session. For those that don't know Zurich's position, they are considered the leading provider of employer-sponsored pensions and savings arrangements in the Middle East, and they utilise that experience as the appointed administrator for DEWS. And Daniel manages the day-to-day relationships with our key participating employers, and it's great to have him on the call today. Just to cover off the agenda very quickly, initially, I'll talk through the DEWS structure and oversight just to give you a feel of how that looks and where that came about from. And then we'll pass over to the Mercer team, who will cover off an overview of the DEWS investment range, an update on the market, the investment options that are available to you and what their historic performance and the potential outlook is. And then they'll step through some guiding principles around investments. And as I said earlier, there's time for Q&A at the end. We should be covering that all off in approximately 30 minutes. Again, if there's any questions, please ask them. There's always the ability to ask the questions afterwards through the usual channels. So just from a operating model, I'd just like to sort of cover off how that looks, and what you can see on the screen there is the operating model that comes together to create the DEWS arrangement. And this arrangement was designed by a working group of industry experts over a three-year period. So prior to DEWS being launched, a group of industry experts came together to design how it should look, how each component should come together in order to provide a market-leading solution. And as part of that, there are three main segregated and separate roles, which are a master trustee role, and that's the role that's performed by my business, Equium. Then we have the administrator role, and that's performed by Daniel's business, Zurich Workplace Solutions. And then we have the investment advisor role, and that's Assad, Nora, and Julius's business, and that's performed by Mercer. And each of the three companies would be considered the market leader in their particular role in industry in the Middle East, and each were appointed through a competitive RFP process back in 2019 before the launch of DEWS. And the three companies come together in order to produce the DEWS plan that you all benefit from. As an added layer of protection, and very importantly, to provide enhanced oversight, there's an independent supervisory board that was created from outset. And the main purpose of the supervisory board is to ensure that the three appointed providers, Equium and Zurich and Mercer, are carrying out their roles efficiently and correctly. And on a quarterly basis, we all meet with the supervisory board to report on our individual performance, to provide relevant updates and to ensure that the plan is running efficiently. So hopefully that gives you a feel for how the DEWS plan works, the levels of oversight and the experience that comes together to create and run it. With that, I'd like to pass over now to Assad, Nora and Julius, who will kindly walk us through the investment update information. Thanks, guys.
Great. Thank you very much, Chris. Good afternoon, everyone. Thank you all very much for your time. As Chris mentioned, my name is Assad Hussain. I'm an investment consultant in the Mercer team based in the DIFC. And given we have a broad audience today, including some of you that may be new to the DEWS plan, we thought it might be useful to just start off by providing a brief overview of the DEWS investment range. I'll then hand over to my colleagues, Julius and Nora, as Chris mentioned, and they'll cover off the market environment in more detail on the DEWS plan's investment options and performance. So as many of you will know, the DEWS is a savings plan, and when your employer makes contributions into DEWS on your behalf, that money then gets invested into one or more investment options, which is what is shown on this slide. The aim of each of these investment options is to make your money grow over time and generate returns and help you meet your individual savings goals. We know that members have different investment needs, different time horizons, different attitudes to risk. So there's a range of investment options that are offered within the plan that you can choose from. The chart here specifically shows the investment options based on their expected long-term risk and return characteristics. So if you look on the horizontal axis, it shows expected risk or volatility. And on the vertical axis is expected return that you can expect from each of these options. The more risk you take, the higher returns you can expect, but also the more volatile those returns will be. And higher risk can also expose you to higher falls in the value of your investments. Just to illustrate this, on the bottom left-hand side, you have the low growth option, which is a very defensive option, mainly invested in US dollar cash deposits with global banks, and also short-term high-quality money market holdings like government bonds. And typically, this kind of option would be suitable for people who are risk-averse or have a short time horizon. And then on the upper right-hand side, you have the higher growth options. So these are more aggressive growth-focused options, and they're largely invested in growth assets like equities. And typically those will be for members who can take a bit more risk or have a longer time horizon. Just to mention, all of the options shown here are carefully selected by the trustee after taking investment advice from Mercer. And the underlying funds within these options have dedicated fund managers who are responsible for identifying and managing the relevant underlying investments. If you don't make a choice between these options, your money automatically gets invested in the default option, which is the low moderate growth fund, which you can see in the middle of that chart. And that default option is a balanced mix of growth and defensive asset classes. You can also invest in more than one of these options if you choose to do so, and you can switch between the options at any time as well. Lastly, you should just note that returns are not guaranteed. Returns will rise and fall in line with market performance, but returns are expected to be positive in the long run. The trustee, as Chris mentioned, also regularly reviews the performance of all of the investment options, and they'll make changes to this investment range wherever it's appropriate. And with that, I'll quickly just hand back over to Chris to discuss the latest addition to our DEWS range. Chris?
Yeah, thanks, Asad. So in May this year, the DEWS investment range expanded with the addition of the Islamic Mudaraba option, which is provided by National Bonds. And hopefully everybody received an email to notify them of this addition. The option is Sharia compliant, and it aims to deliver money market-like returns, focusing on capital protection and income distribution. It has a posted annual profit rate, which is currently 4% gross of DEWS provider charges, and returns are added to members' accounts on a pro-rated monthly basis. Investors also in this option are eligible for the National Bonds Reward Programme, and any prizes that are won through the programme will be converted to a monetary value and allocated to a member's voluntary contribution account, and you would be notified as well. If you want to know more about this investment option, you can find it through the DEWS website, which is zws.zurich.ae. Thanks, Asad.
Great, thank you, Chris. So I think lastly, I just wanted to quickly point out that there's a lot of resources that are available to you through the DEWS app and through the DEWS website, where you can learn a lot more about the DEWS plan. For example, there's a detailed investment guide which is available, which has a lot of information on all of the investment options. You also have access to monthly fund fact sheets for each of the investment options. And then you also have access to a fund center where you can see things like unit prices, and you can compare performance through the fund center as well. I'll also quickly just point out that we're going to be hosting a series of general investment education articles through our website. So please keep an eye out for that. We're looking to release those in the coming weeks as well. So with that introduction, I think I'll now hand you over to Julius, who's our European Head of Dynamic Asset Allocation, and he'll provide an update on markets and also our current views on different asset classes. Julius?
Good afternoon, everyone, and thanks, Asad. So, first of all, let's start with the broad economic picture. And there's a lot of going on this chart, but I'll explain chart by chart what all of this means. But if you look at the top left, basically global economy has done quite well this year. As you can see on the left-hand side of that chart, a lot of the bars are pretty high, suggesting that the growth rates for key global economies have been pretty strong, particularly in the US. And now, as we journey into the gray area, which is over the next 18 months or so, we expect global economy to continue to do well, but maybe not as well as last year. But what is clear to us, looking from the latest data, is that the risk of recession remains fairly low. So the first thing I would take away as you look from this chart is that global economy should look a lot more normal in 2025, and the risk of recession, in our view, is fairly low. Now, as we journey to the right-hand side and the top right chart, inflation and this is the measure that the Federal Reserve prefers, inflation has come down. And the blue line shows inflation if you exclude the volatile items like food, energy, and the green one is including everything. And you can see that both measures have come down meaningfully to the point where they're actually around the rate that is targeted by the central banks. So to put it another way, the inflation problem that was very much there over the last 3 years appears to have been resolved. And as we go through the 2025 on a forward-looking basis, we think inflation will be normal. So that's another takeaway. Not to sound too repetitive, but we think inflation will look a lot more normal as we go through 2025. Now, if you look at the bottom left, and this is very important, one of the key reasons for inflation has been wage growth. And as wages rise, prices rise, and then people go back to their employers and they ask for even higher pay, then in order to protect their profit margins, the employer increases the prices even further, and so it spins. And what we've seen recently is that because the labor markets have shown signs of cooling, with unemployment rates picking up a little bit, job openings coming down a little bit, wage growth has been coming down. And you can see in the shaded area in the bottom left that the forecast is for wage growth to continue to fall, which would mean that the inflation pressure that comes from it should be reduced. So my main thesis from all of this is that the key underpin of inflation we think is going away. And that's why I'm quite comfortable telling all of you that the inflation problem is broadly resolved. And on the bottom right, what you see is that against the backdrop of economy normal, inflation normal, we think central banks should be normalizing their policy. And that means different things for different central banks, but broadly that means interest rate cuts. And as you've seen over the last 18 months, emerging market central banks have been cutting rates. And lately, developed central banks have joined the party and started cutting rates too. And you can see the blue line has been increasing as the Federal Reserve lately has joined the interest rate cutting cycle in order to normalize policy. So for your benefit, if I could summarize all of this in one word, if you can take away a summary in one word, I would just say normal. Growth to normalize, inflation to normalize, and interest rate policy to normalize too. Now, moving to the next slide, the markets have been, I would say, fairly happy as far as the macroeconomic dynamics concerned. Equities have rallied, although August was a volatile month driven by a number of technical factors. But you can see overall, global equity markets have done quite well if you look at the top left. Top right, bond markets have been a little bit more mixed. At the start of the 2024, bonds have sold off a little bit because of fears that inflation is coming up again. But since that narrative has lost ground and inflation has continued to normalize and bond yields have come down as a result. Now, on the bottom left, in the currency markets, dollar has been a little bit mixed. The key mover this year was the Japanese yen. It's depreciated a lot early in the year, and it's rallied since quite a bit. And in our asset allocation thinking, that's one of the currencies that is very interesting. But overall, I wouldn't say there's a major takeaway from a currency perspective, just to note that the Japanese yen continues to be very interesting. And on the bottom right, we show credit spreads. And for those not too familiar with the concept, it's simply the difference between the yield on an investment grade bond or a high yield bond minus the yield on the government bond. And that spread is the extra return you pick up from investing in this slightly riskier or even more riskier asset class. And lately, spreads have come down, suggesting that the risk of recession implied by this market is quite low. And that's the dynamic that's unfolded. We think it's reasonable because global economy is likely to be resilient, so default rates should be fairly low. So credit spreads are reasonable to be at quite low levels. So that's the market's dynamic year to date. Now, what we see quite interesting is the top left. We think equities are quite interesting, although valuations, as defined as price divided by earnings, have been coming up. So the opportunity is maybe not as attractive as it used to be, but we still think it has room to run because of the encouraging macroeconomic backdrop. And within equities, we think EM is very interesting because it's very cheap. As you can see, the difference between emerging and developed, as defined by the pink bar, is high, and EM, or emerging market assets, are much cheaper than usual, which in our view is an interesting opportunity. On the top right, it shows the government bond yields. We think they're not overly interesting. In fact, we think right now maybe it's not a terrible time to be a little bit underweight, because they're expecting a lot of interest rate cuts by the Fed, and we think some of those might not be delivered. So we think bond yields are probably moving lower over the next 18 months, but maybe not as much as the market expects. So we think one should be a bit more cautious about bond yields today from a dynamic perspective. As you can see, bottom left, the credit spreads are a little bit too tight, so we're not overly excited by it. And there's a number of asset classes that are more interesting in it. So like Asia high yield is something that we still like a little bit more. And it won't surprise you that we're excited by Japanese yen because it's very, very cheap, as shown as the bottom right. So in terms of overall opportunities, equities are okay, growth fixed income is okay, government bonds not so much right now, and then currencies, certainly Japanese yen is looking very interesting. And moving to the final slide, by way of more visual summary of what I've just said, as I said, equities are interesting. Within equities, EM is interesting. Where possible, we try to allocate to emerging markets debt too, or frontier markets debt. Japanese equity, yen, is quite interesting. Real estate investment trust are interesting from our perspective. Asia high yield, as I just mentioned, is an asset class that is quite intriguing from a valuation perspective. And we fund some of those positions by being a touch underweight developed markets equities and a touch underweight global government bonds. So this is the asset class views from a dynamic perspective. And by way of quick recap again, as far as the macro is concerned, growth normal, inflation normal, policy normal. And against that backdrop, equities are interesting. Growth fixed income is quite interesting. Government bonds are not so interesting. And certainly in the currency space, there's a number of very interesting opportunities. So hopefully all of this gives you a little bit more flavor as to how we think, what we find interesting from a dynamic asset allocation perspective and from a macro perspective. And I very welcome as many questions as you'd like to ask. Thank you very much.
That's great. Thank you so much, Julius. I think we'll take the questions at the end. I think at this stage, I'll hand over to Nora to go through more of the detail around the structure of the DEWS funds, as well as their performance over the year so far. Nora, over to you, please.
Perfect. Thank you. Thanks, Asad. Thanks, Julius. And good afternoon, everyone. So in this section, we'll look at the asset allocation in a bit more detail. And as Asad explained, a wide range of investment options are available. But just given the time available today, I'll focus on the low moderate growth option, which is the default option and which is where the majority of plan assets are invested. So this first slide summarizes how the asset allocation for each of your multi-asset options is determined by our multi-asset portfolio management team. So the starting point is the long-term return objective. And for the low moderate growth option, this is a return of 2 to 3% per annum ahead of cash over the medium to long term. And the key driver of that return will be the strategic asset allocation. So that's the diversified range of asset classes that's expected to best position the fund to achieve its long-term return objective. And that's reviewed annually. And our 2024 review was just recently completed and implemented. And then in addition, we have dynamic asset allocation tilts, which are shorter term adjustments to the long-term strategic asset allocation to capitalize on market inefficiencies or mispricings and to look to add incremental returns in a risk-controlled way. We'll also use active management where it's expected to add value as well. So then the next slide then shows the strategic asset allocation of the low moderate growth option. So it's well diversified. And on the left-hand side, you can see the underlying building blocks with 65% invested in diversified growth fund. And then the right-hand side shows the look-through with 38% in equities, 35% in defensive fixed income, and then also allocations to alternatives, growth fixed income, and cash. And earlier this year, in line with our commitment to continually enhance the options, we introduced local UAE assets with the Emirates Islamic Money Market Fund replacing the existing USD cash fund. So 8.5% is invested in the Emirates Islamic Money Market Fund. On the next slide then, we've got the asset allocation of the Diversified Growth Fund, which, as I mentioned, makes up 65% of the low moderate growth option. So the blue bars show the long-term strategic asset allocation, and then the pink bars show the shorter-term dynamic asset allocation tilts. So the fund is well diversified across and within asset classes. Given its long-term growth objective, it's primarily invested in equities and other growth assets such as emerging market debt, but also includes allocations to defensive, bonds, alternative strategies, and cash for diversification and downside protection. And as Julius mentioned, the dynamic tilts are currently overweight equities with overweights to emerging market equities, Japanese equities. There's also positive tilts to REITs, local currency emerging market debt, Asia high yield, and short duration bonds. And the strategic and dynamic asset allocation of the other multi-asset options is consistent with this. And obviously the higher the long-term return objective of the option, the more it will have invested in equities and growth assets. So that's important, I suppose, to bear in mind the asset allocation when reviewing the performance, as the asset classes will really, in which the fund is invested, will determine the performance achieved. So with that in mind, we'll look at performance now. So in this slide, what we have is the cumulative performance of the low moderate growth option since inception in blue, the cumulative return on cash over the same period in green, and the target for the low moderate growth option is in purple. So you can see that the cumulative return is well ahead of cash and ahead of its long-term objective throughout the period. Returns here are shown net of sub-investment manager fees, but before all other fees. This is a growth option, so there will be some ups and downs in returns, as you can see by the ups and downs in the blue line. But overall, it's ahead of its target since inception. The next slide then shows the same type of information for the Diversified Growth Fund, with the Diversified Growth Fund performance in the blue line. It's got more invested in equities, so there's more ups and downs in returns, more volatility, but again, ahead of its target since inception. The next slide again then shows the added value from the dynamic asset allocation tilts. So the blue bars show the added value quarter on quarter, and this can vary depending on the opportunities available. But the blue line shows the cumulative added value from dynamic asset allocation tilts, which we're really pleased is being a strong positive added value since inception. On the next slide then, we have the performance of each of the investment options available to you. So the funds listed down the left-hand side, and just, I suppose, I'm conscious there's quite a lot of data on this slide, so we've highlighted two columns. The first on the left is the return since inception, and then the second column highlighted is the 1 year to the end of August. Pleasingly, all the funds show positive returns across the majority of periods, and strong positive returns, largely reflecting the strong performance of equity markets over time. I suppose all funds, absolute returns are positive, and relative to their long-term targets, the funds are performing quite well there as well. The one fund with a negative return since inception is the Global Sukuk option, and the negative return there, slightly negative, is not surprising given how interest rates have changed over the period since inception. Returns on this slide are net of fees, but an important point to flag on this slide as well is that this slide shows fund returns, and members' performance may differ from this, as the returns for each individual member will depend on the dates in which your contributions are invested. I suppose, just given the time constraints today, focus primarily on the low moderate growth option, but there is a wealth of additional information to you available to you on your member portal. So then just onto the final section then is some investing guiding principles. We can't provide you with investment advice, but this section sets out some principles which you may wish to consider. So there's 4 key questions to ask when making your investment decision. What's your attitude to risk? How comfortable are you with ups and downs in returns in the pursuit of long-term growth? How long do you expect to invest your savings? If you have a longer time horizon, you may be able to take more risk in the pursuit of long-term returns. How do you intend to use your savings? And what are your personal circumstances and financial situations? So if you're saving elsewhere, that might influence the level of risk and return that you are targeting in the plan here. It's important to consider your answers to these questions, and also to regularly review them over time, as your answers will likely change as your circumstances change. So on the next slide then, just some additional pointers. So do, make sure you understand your investment choices and your objectives. Know where to access information. And again, as Asad outlined, a wealth of information is available on your member portal, including your investment guide and fact sheets. Do regularly see how your options are performing. But if you have a long-term time horizon, it's important to review your savings plan as a long-term investment, and don't try to time markets. It's incredibly difficult to do and carries significant risk that badly timed investment changes can lock in losses or miss market recoveries. And just a simplified example of that is provided on the next slide. So starting on the left-hand side, we have Mary, who's invested in growth options. And at the start, she's quite pleased. The performance of the growth options is going up, so the blue line is increasing. But then there's a drop in the market, and Mary is concerned. So she moves her savings into conservative assets, as illustrated by the pink line. Initially there, she's pleased as well, because the growth assets continue to fall, and the pink line, the conservative assets, provide a stable return. But then the growth assets recover. There's a sharp increase in the blue line, and Mary moves back into growth assets, but misses the bounce in markets. And ultimately, the green line shows the performance that she achieves. So I suppose it's an illustration, but hopefully it does illustrate the difficulties of trying to time markets. I suppose we hope this presentation has been helpful to you today in assessing your options. No action is required, but you may wish to check that you're satisfied at where your savings are currently invested. And it is a personal decision which will depend on your circumstances and requirements. I also want to highlight the information in the blue box. Nothing in this presentation constitutes financial advice. None of the service providers here, including the trustee, is allowed to give you advice about your financial planning or decisions. And if you do wish to take advice, then it's recommended that you speak to an independent financial advisor. But I'll hand back to Asad now at this stage, and we'll go through the Q&A section, I think.
Great, thank you very much, Nora. That was really helpful. So yes, we will move on to the Q&A section next. I believe there's been lots of questions coming in. Just before we do move on to the Q&A, I just wanted to highlight that we've got the contact details listed here on this slide. I'll leave this slide up. Just in case you had any questions after this presentation, please feel free to send them over to that email address shown on the screen. And you can also visit the DEWS website to find a lot more information, including things like the investment guide. There's also a QR code on the right-hand side. So we'd really appreciate if you could have a quick scan of that and give us some feedback on this webinar. And with that, I think I'll hand over to Daniel to take us through the questions, please.
Yes, thanks, Asad. Good afternoon, everyone. As mentioned, we're going to run through the Q&A both verbally, but we're also answering questions that you've posted through the chat as well. So we're busy doing that, and then we'll get to these questions now. So number one, the performance figures you have shown don't match what I can see in my account. Why is that? Maybe a question for you, Asad?
Yeah, sure. Thank you very much, Daniel. It's a good question. I think Nora mentioned this in the slide where she was talking about performance, but the performance figures that we show on the slides here are time-weighted returns. So that's a measure that's generally used when assessing the performance of fund managers. What you'll actually see in your account is money-weighted returns. So money-weighted returns take account of the size and the timing of the actual contributions into the plan. The reason that we show time-weighted returns on these slides is because those are more reflective of actual manager investment decisions. So the underlying managers won't have control over the timing and size of contributions into their funds. But that's why you see the discrepancy between your account versus what's on these slides.
Thank you. Next question. What is the significance of the reduction of interest rates from the US Federal Reserve last week? And how will that impact investment performance? Maybe one for Julius.
Well, it's certainly significant because the Federal Reserve has engaged in one of the most aggressive tightening or interest rate rising cycles over the last 3 years or so in order to take care of inflation problem. And now that they've begun cutting rates, that signals that inflation is a problem broadly resolved. And generally, when interest rates are being cut, that tends to be a pretty good environment for growth. That tends to be a pretty good environment for asset prices, such as equities. That tends to be a pretty good environment for government bonds. So it is very significant. It's a positive development for global risk appetite, I would say. But the thing to keep in mind is that markets are based on expectations. So a lot of that, or a lot of the interest rate cuts that the Fed have already delivered, they're already expected by the market in the future. So the actual reaction in bond markets and in equities will depend to what extent Federal Reserve over or under delivers versus expectations. So while generally speaking, interest rate cuts is a good thing for risk, one needs to be very conscious about the market getting ahead of itself and expecting too much, in which case it might be a touch disappointed. So it's a nuanced answer, but certainly one to keep a close eye on, because as we know, interest rates in the US is arguably the most important variable for global economy and global financial markets.
Thank you. Next question. Are there any index tracking options available in the fund range? Asad?
Yeah, sure. Thanks, Daniel. Yes, we do have a couple of index tracking options available within the investment range. So one is the passive global equity option, which tracks a global developed market equity index. And we also have the Islamic global equity option, which is managed by HSBC and also tracks Sharia compliant index composed of both global developed and emerging market stocks. And I think I'd also add to that a lot of the underlying components that are used within our multi-asset fund range are also built using passive index tracking components. So there is a lot of use of passive management within the DEWS plan.
Okay, thank you. A question, I think, for Nora. Do you invest in Bitcoin or other cryptocurrencies?
We don't invest in Bitcoin or other cryptocurrencies. The funds are very well diversified, but we don't currently invest in Bitcoin or cryptocurrencies, just given I suppose, the extreme volatility that can be associated with those. And there's also regulatory constraints in place for the funds. So under the fund structures that we use, primarily UCITS, we're not currently allowed to invest in Bitcoin or cryptocurrencies.
Thank you. Next question. Do I have to wait until I leave employment to make a withdrawal? I'll take this one. So you do if it's for your employment, so your mandatory employer contributions, you cannot withdraw these until you leave service. However, if you've been making voluntary contributions, you can withdraw on those. That flexibility is a great benefit, and you can withdraw up to 60% of those voluntary contributions per year. Next question. Why does Mercer not invest more in growing economies like India and China? Maybe one for Julius.
Well, we certainly believe that these economies are great economies with great momentum, particularly India lately. And we think over the long term, they're going to grow at an accelerated pace, and they'll be dominant in the global GDP equation. And that is certainly something we as a house have sympathy with. Now, in terms of investing more or less into it, it's a question of how much active risk versus global equity benchmark do you want to take. And right now, our best belief over the long term, over strategic long-term investment horizon, is to invest in these economies as much as the broad global equity benchmark invests in them. And while we're encouraged by the structural story, we don't think it's something that will meaningfully outperform other equity markets such as the US and Japan and others. So over the long term, we prefer to keep those allocations close to home, if you will, or close to the benchmark implied weight. Now, over dynamic horizon, the question is slightly different, and in it, we're a little bit more encouraged. So as discussed in my session, we are a touch overweight emerging market equities, which of course are primarily dominated by India and China, and that is expressing a view that is positive on those economies, because we think over 6 to 18 months horizon, the news flow on them is going to be a little bit more encouraging, which should lead to higher earnings growth, which should lead to outperformance of those equity markets versus other ones. So when thinking about the two, there's the shorter term, which is a bit more encouraging, and the longer term, which is a bit more neutral. But at a high level, these economies, certainly the two, one should keep a very close eye on over all time horizons.
Thank you. Next question. Do the investment options factor in ESG, environmental social governance considerations? One for Nora.
They definitely do. So from a number of different perspectives. So the underlying investment managers that are appointed, the passive and active managers, we look to appoint managers who are highly rated in terms of integrating ESG into their investment decision making. We strongly believe in stewardship, so engaging with companies and using voting rights to promote positive change. We allocate to sustainable investments, so we'll have specific allocations, say, to sustainable equities, or use asset classes that incorporate ESG tilts. We do exclude some securities as well where appropriate. For example, we would exclude exposure to tobacco or controversial weapons. And we also have net zero commitments in place for each of our multi-asset options. So the funds have a net zero 2050 commitment in place as well. So yes, definitely lots of ESG considerations in the funds.
Thank you. One for Chris: is the DEWS plan audited? You're on
Sorry,
mute.
just struggling to find my mute button. Yes, it is audited on an annual basis. Under the DFSA regulations that we sit, there is a requirement for an annual audit, and it's been carried out every year since the plan's been set up since February 2020. The appointed auditor is KPMG. And we post the audited accounts onto the DEWS website. I've seen a question come in around speed of getting the audited accounts available. So we try to make them available as soon as we can. We're trying to push it further and further closer to the start of the year. Also, that was requested by the DEWS Supervisory Board. So we are trying to get that done quicker and quicker. It does take a bit of time because there's so much data that's in there. But to answer the question, yes. Just another question that I see coming through on the Q&A, and I know we are limited on time, is just around the charges and what the charges are for the overall arrangement. So just to be clear, the provider's charges for Zurich, Equium and Mercer comes to 1.23%. And then there is fund charges on top of that, depending on which fund you're invested in. So each fund will have its own underlying charge. They're all institutionally priced. For the default fund, it's in total it's 1.39%, and that includes the 1.23% of the provider charges as well. And all of the information around charges can be found on the literature that's available on the DEWS website. Just as well, I know we're running out of time and there's a lot of questions coming in, but if there's any questions that don't get answered, please post them to dews.support@zurich.com that you can see on the slide, if that's okay, and then we'll try and get the responses back to you, because it's very difficult. We're trying to answer the questions as we go through, but if there's any that don't get covered, if you can post them through, we'll make sure that you get a response. Thanks, Daniel.
Right. Thank you, Chris. One again for Nora. Are you using any strategies to protect against inflation risk in your options?
We are. So as part of the annual strategic asset allocation review that I mentioned, we do complete stress testing and scenario analysis to look at different types of market environments. And I suppose one of those considerations is exposure to inflation. And we have specific allocations to global inflation-linked bonds, allocations to gold, commodities, to address inflation risk, and I suppose even just the allocation to equities itself over the long term should provide a protection against an inflation risk as well. So it's definitely considered as part of fund construction.
Okay, thank you. I guess this is for Chris. What will happen to my money if my employer goes out of business?
Great question. I think this is one of the fundamental reasons why DEWS was created, was to provide the protection for employees should their employer fall into financial difficulty. So in that eventuality, the money, when it flows into DEWS and is held and invested, is held in the name of the trust, or held within a trust. And that trust structure is away from the ownership of the employer. So should a company get into financial difficulty, the money's segregated away from the ownership and would be paid out to the individual on receipt of the necessary paperwork. So effectively, the employer or liquidators can't access the money. It's held aside. In the eventuality of financial difficulty, we would be notified, and then we would pay away then to the employees once we receive the paperwork.
Thank you. Next question. How often is the investment range reviewed, and will new options be added in the future? Maybe for Asad.
Sure, thanks, Daniel. So the investment range is reviewed on an ongoing basis. We have formal quarterly meetings with the trustee and the supervisory board, where we go through a whole range of details, including historic performance, our views going forward. We also conduct annual strategic asset allocation reviews for the multi-asset options, as Nora had mentioned in her section. And every 3 years, we also do a full investment strategy review with the trustee. So that looks at the plan as a whole and just considers what can't be added at that time. So it's reviewed on an ongoing basis, and whenever the trustee deems it appropriate, new options may or may not be added to the plan.
Great, thank you. Next question, can I change to a new employer and still keep my money invested in my current options? I can take that one. So when you come to leave your company, there'll be 3 options. Obviously, you can take a full withdrawal, you can take a partial withdrawal, or the third option is you can remain invested. So that pot of money will remain invested in the market. You will no longer be able to contribute to it because that has to come through your employer. And if you went on to join another employer, again within the DIFC, you would then have that as your active account. So effectively, you'd have one account in the background, which you can't contribute to, and then you would have your new account with your employer mandatory contributions going into. So yes, you can. Next question, is it possible to invest in private equity through DEWS, Asad?
Good question. Currently, it's not possible to invest in private equity. One of the main reasons for that is really operational reasons. So the DEWS funds are daily priced and daily dealing funds, which is very different from the kind of illiquid private equity assets that you would find in that space. So it's not something that's impossible in a defined contribution environment, but at this stage, we don't have exposure to private equity through DEWS.
Okay, great. I'm just thinking in the interest of time, I know we've run 5 minutes over. Chris mentioned about us coming back to you for any unanswered questions on the DEWS support line. Chris, are you happy to take it back?
Yeah, no, thank you, Daniel. Sorry, just to wrap up then, and I know we've had a lot of questions. Hopefully, we've answered the main bulk of them. As I said before, we're here to help. So if there are any questions that have been that we haven't covered or anything that people want to know, please reach out to us. The website, there is a lot of information that's easily available within zws.zurich.ae. I would highly recommend going through that if you want to find out more about the arrangement. If you have any individual questions and ones that we haven't covered off, as I said, please drop an email to dews.support@zurich.com or give a call to the helpline on 800 3397. Just to finalise, thank you very much to the speakers today for their time and for providing the information. It's always great to take opportunities to understand how the arrangement works, but also from an investment perspective, how things are performing, what the outlook is, and what the options are that are available to you. We are committed to provide the webinars on a half-yearly basis, and also we'll be providing information alongside that on a regular basis as well. So again, I'll call the call to a close there. Thank you very much for everybody's attendance. It was great talking to you, and I wish you a great rest of the day. Thank you.
Thank you.
Thank you.
Thank you so much, everyone, for attending. If you get a moment, please scan the QR code and it'll be able to provide us feedback. Your feedback is very important to us. Thank you.
I'm going to drop off the line, guys. Thank you very much for everybody attending. I think it seemed to go well. I think if we can follow up on the Q&As, but we catch up separately.
Sure. Thank you, everyone.
Thank you.
Thanks.
Thank you.